First, we have Gary Brode from Deep Knowledge Investing. Gary works with hedge funds, family offices, and RIAs to help them get better returns by researching specific stock ideas, so we're looking forward to that. And he also recommends a specific portfolio as well as doing a macro analysis. Then the first person we have right here is Greg Barasia. Is that correct?
Close enough.
Close enough, thanks. He's the founder and chief investment officer of Cedar Capital, which is a global macro investment firm in New York, which is launching, and I think he needs a clap on this one, June 1st. He has a lot of international investing experience. Hopefully he can explain the dollar to us here. And a lot of experience with global markets, macro, and geopolitical risk. Then we have Jennifer Oppold from Alpine Peaks Capital. And I've actually personally known Jennifer many years. And she started out at Select Equity for 10 years, which is a fabulous firm, and has set up her own firm to do both long-only and long-short as a concentrated, longer duration investments in small and mid-cap managers primarily. Prior to starting at Select Equity, she went to Princeton and got an MBA JD from Harvard. Then we move on to finally Jeff, also comes with an illustrious pedigree. Jeff founded Incline after working at Tepper, and an old friend of mine, David Tepper. So I'm a big fan already, Jeff, just knowing that you were there. And he's had 20 years of portfolio management experience, and now is running his own firm, Incline Global Management. And he will also have a lot of good, interesting ideas, because we were talking earlier, and some of his ideas are actually divergent ideas from other people. So I think that's in particular quite interesting to hear about. So without further ado, we're going to move on, and we're going to let each of the funds talk a little bit about their ideas. And we're going to start with the people that have a slide so that we can... Okay, so that's Greg Barasia. Strategic, non-correlated approach. Everybody has 10 minutes. I'm going to start the button. Go.
Is this on?
Yeah.
Should I click myself? Or?
You can raise your hand.
Okay, so you can go forward. One more. Okay, okay, so thank you all for coming. As mentioned, my name is Gregory Barasia. I founded Cedar Capital. So Cedar Capital attempts to look at global markets from a macroeconomic and geopolitical lens. Everyone has obviously seen the recent volatility in the markets, but I think one thing that's interesting about the volatility is that a lot of it has actually been driven by geopolitical news rather than traditional quote-unquote financial analysis. So we believe that now is a perfect time for our approach, which kind of looks at the world in a global environment and tries to identify opportunities in places that other people might not be looking. So to illustrate my presentation today, we'll hopefully provide a small insight into how we think. And you'll see that there's very little, again, quote-unquote, financial analysis. The opportunity that I'm going to present is a geopolitical story. It's a story of changing alliances in a very volatile region. And the story begins with a small country on the eastern Mediterranean. Many of you may be familiar with Lebanon. 6 million people. And in the 50s and 60s, Lebanon was essentially the jewel of the Middle East. People considered it to be economically progressive, socially progressive, and the country looked like it was very much poised for a bright future. Unfortunately, in the 70s, things became increasingly negative, and over the last 50 years, the country has been mired in numerous wars, both internally and with neighbors, Syria, and conflicts more recently with Israel. All that being said, in the late 2010s, it looked like the country had rebounded and that there was an opportunity for it to regain its lost glory. And the GDP of the country had been growing steadily. The country was able to issue US dollar-denominated bonds, and it looked like things were on the up and up. Unfortunately, in 2019, things started taking a turn for the worse. First, there were mass protests in the street. The currency started a massive devaluation, ultimately losing about 90% of its value, and the banks instituted capital controls, making it almost untenable to be in the country. In 2020, the country defaulted on its US-denominated bonds, and as if that wasn't bad enough, later that year, there was the Beirut port explosion, which was one of the worst explosions in the history of the world, and it leveled almost half of Beirut. So with that, before I explain to you why I think this is an opportunity, just pointing you into what's the actual instrument that I would look at. So as I mentioned, Lebanon has issued US dollar denominated bonds. The country has about $31 billion of US dollar denominated debt, about another $6 billion of LBP, Lebanese pound denominated debt as well. So about 188% debt to GDP. As I mentioned, the bonds are currently in default, and they're trading below 18 cents on the dollar at the moment. I believe that the bonds can trade up to 35 cents within the next 36 months. So you're looking about 99% returns. Annualized would be around 26% returns. So why do I think so? So first, let me start with kind of the more recent events in the near past. In 2023, the country finally stabilized its currency by effectively becoming dollarized. That led a significant amount of stability to the country. And then more importantly, over the last 8 months, there's been a number of events that have really put it on the path towards recovery. So first, the killing of Hezbollah leader Hassan Nasrallah, who was killed in an airstrike by Israel. That night, the bonds rallied by 33%. After that, there was a ceasefire with Israel. And then early this year, the country was able to form a government for the first time in 3 years. So that goes to show you the level of dysfunction that had been in the country, that it had been 3 years since they've been able to form a government. On the back of all of that, the bonds spiked to where they are right now, trading between the 17 and 19 cent range. So where do we go from here? Again, as I said in my opening, this is a geopolitical story. And the key geopolitical theme to think about, both in the region and really more globally, is the Iran anti-Iran axis. As you saw even with the Abraham Accords that were signed in 2019, there's been a shifting alliance from those that are pro or on the side or working with Iran to those that are against Iran. Abraham Accords obviously created a peace treaty between Israel and the UAE, Bahrain, Morocco, a few other countries. You see Saudi's willingness to contemplate ties with Israel. And so ultimately, Lebanon creates an important bulwark in the region against Iran. That's being seen not just by the Gulf countries, but also by the European countries and the US as well. There's already been talks around how to essentially reach a settlement around the debt and then ultimately allow for the redevelopment of the country, which is estimated at about $11 billion. So the IMF has hinted that the recovery they would like to see debt to GDP at about 100%. So you can see to the right of the slide here what different debt to GDP would look like based off of an estimated GDP, which is a little bit hard to estimate. And also, I haven't taken into account the fact that there might be additional private government debt as part of the redevelopment. But you can see that all of these get you somewhere in the order of 30 to 45% recovery rate. So if you go to the next slide, this is just a very basic slide showing kind of returns as a function of time and of price. You can see that, in my opinion, there's actually potential upside to the 35-cent level. And obviously, if things resolve more quickly, then the annualized return would be slightly better. So with that in mind, essentially what you're looking at is an asymmetrical digital option. So then we have to think about kind of risks and sizing. So the risks are broadly in 3 main buckets. The first is kind of an ongoing deterioration of the country and the region. We kind of know that there's a floor of about 6 cents on the bonds, which is what they were trading at about 18 months ago. And I would say that floor is more likely at 10 cents, is where they traded after the killing of Nasrallah. I think the biggest risk is actually just a delay. Obviously this would take up capital, and there's an opportunity cost to that. If this winds up taking 5 years instead of 3 years, your annualized returns are much lower. And then there's the fact that there could be just a global macroeconomic slowdown. About 37% of the bonds are held by international investors. If asset prices around the world go down, they could be forced sellers. So how do I think about sizing in that environment? Essentially, the way I would look at it is assume it has 100% annual standard deviation. At Cedar Cliff, we look at everything from a risk-weighted allocation. So if you assume 7 themes with equal risk, say you want to have roughly 3.5% allocation of risk to the trade. On a $50 million portfolio, that'd be $1.75 million of bonds. Now, the bonds trade roughly $40 million a day. So if you assume you don't want to have more than 20% of the average daily trading volume, that's $8 million. You could probably trade this in meaningful size up to a $200 million portfolio. So finally, you can see how this trade would fit into kind of an illustrative portfolio. As I mentioned, given the risk weighting in the assumed volatility, it makes up about 3.4% kind of in the bottom. It's a little bit small. And you can see how you would kind of allocate around that. So this presentation was a very brief overview of how I think about the world, how we think about the world at Cedar Cliff Capital. Obviously, I could spend hours discussing this and the history and the economics and the geopolitics around it, but given the time constraints and the fact that there's a Knicks game coming up, I'm trying to give you a high-level approach to how I think about investing, but happy to discuss further with anyone who's interested in learning more about the trade or Cedar Cliff more broadly. Thank you very much for the time.
Thank you. And that was 8 minutes, so very good. Moving on to Jennifer. At Alpine Peaks, we already gave a little bit of a background.
So Susan already covered this. This was my background. I wasn't sure how much we covered, but I don't think we need to repeat that, so we can go on to the next slide.
Great. So I thought that I'd actually start by showing you our top 10 positions, just to give you a sense of the portfolio. And one of the things that our investors often tell us is that our holdings tend to be unique from the other funds in their portfolio, adding diversification to their overarching portfolio. So just wanted to give you a flavor of this. We specifically we seek out long-term compounders, high-quality companies that we think can compound investors' capital across business cycles. And I know high quality can be a little nebulous, so we are specifically looking for durable revenue growth, for healthy operating margins, for strong returns on invested capital. We like to see low debt. I started my career during the financial crisis, and I really like strong balance sheets. And then finally, strong free cash flow. And so usually equivalent to or better than net income. And we found that companies that typically have those financial characteristics usually have strong moats of one type or another on their business. So Susan, if you could go on, thank you. So here we are. The company that I'm going to talk about today is Bright Horizons, and so this is going to be, I think, a great night because it really skews in, I think, in quite different directions among the four of us. Bright Horizons was a classic compounder for a long time. So essentially it was a daycare business. It started out, its genesis really was in serving corporate employers who, here I included some BLS data just showing the rise of women in the workforce and essentially dual income families. And as that occurred over time, corporations increasingly offered daycare as a benefit to retain employees. And so often either co-located or they offered it partially subsidized. And so Bright Horizons grew a business that was about 60% dedicated to employers, and then the other 40% was more classic, essentially community centers where you could just go to the door and enroll your child. And this was a great business pre-COVID, one that grew revenue about 10%. It was steadily increasing operating margins over time. So bottom line on average was growing about 20%. So it generated a lot of cash, and it reinvested that in building new centers and buying centers, building out their network. And then COVID happened. And actually we could go on to the next page. Thanks, Susan. And so what you can see here is that the core daycare business used to be about 80% of revenues. These are their full service centers. Used to really dominate the business. It was over 80% of revenue and about 65% of operating profit. So they had a couple smaller businesses, but that was really the meat and potatoes of it. And then that business was extremely hard hit during COVID. Unsurprisingly, I mean, I think we can all think about the reasons why you wouldn't want your kid in daycare during COVID. And what saved their bacon were their two other businesses. And what we think makes Bright Horizons particularly interesting, and what actually makes it a kind of a controversial battleground stock, is their backup care business. I think that there's a division these days between people who see Bright Horizons as it used to be, just as a classic daycare business. KinderCare is another public competitor in the classic daycare business. And then ones who've dug into it and seen that this backup care business actually now really dominates the returns. So you can see there if you could go back a slide, thank you. So the backup care is the light blue there. And you can see it's still not a huge portion of revenue, about 23% last year, but it's an enormous part of operating profits and will be for the foreseeable future. So what this business does is it's a benefit that employers, larger employers, I've always been jealous, I've never had this benefit personally, I have kids, offer employees where it's for days in which care falls through for children, or they offer elder care, they actually offer pet care. But if your kid is sick, if they have a day off from school, if your babysitter calls in sick, you have a certain number of days that are covered by your employer. And you can either, there's a variety of different methodologies, but you can either take them into a Bright Care Center, or you can just find a babysitter to come to your home, and then it's reimbursed through this program. And so often people have anywhere from 10 to 20 days. And it's grown really rapidly, actually, both through increasing adoption. So the reason it makes economic sense for employers, by the way, is not just to be nice, but fundamentally it's better to have, and almost all of their employers are, they're professional employers, their client base is almost all white collar. It just makes economic sense rather than having your employee miss a day of work because they need to care for, their child or parent who, that you can pay somebody a lower wage through this program and have that productivity. And so that's kind of economically why this benefit is growing. So it's growing because of that, and also because awareness grows within a company. And so the first few years, often it takes a few years to get awareness out there. So it's growing about 15% these days. It grew much faster during COVID. And operating margins are 20 to 30%, so extremely, extremely profitable.
It's like the rule of 60.
Yeah, except no software here. And so just as mix improves, and now, Susan, if you wouldn't mind flipping to the next slide. So we think that this is going to be a double within the next 3 years, possibly sooner. I think just as you get the attractive mix change from this really highly profitable business continuing to grow at the rates that it has been. Even we think it'll slow a little, just a lot of larger numbers. And you do have the ongoing recovery, which I haven't touched on as much, but that classic full-service daycare business is still slowly recovering from COVID. That's actually not that fundamental to our thesis. We'd still have a nice return if that business kind of stays status quo. But that's really why we find this stock so attractive. And particularly today, we are seeking out for our larger positions companies that in a really uncertain world will not be particularly impacted by tariffs or economic uncertainty. And this is a business that actually has grown through every recession, except that COVID, the pandemic was an unusual, pandemic-oriented downturn. They did shrink during that one. But typically, growth slows, but they have not had revenue dip in past recessions, including the financial crisis, just because it's one of the last things that people got. And so I'm happy to answer further questions, but that hopefully gives you a sense of, and I should just mention, shorts are a really important part of what we do. We're happy to we do all individual shorts. We talk about them one-on-one. I don't talk about them in venues like this just because we don't want to getting back to the companies that we're short. But if you ever want to reach out and call us, we're very happy to talk about the individual holdings in our short book, which are an important part of our return too. Thank you.
Thank you, Jennifer. That's 8 minutes. And now, Jeff, you want to talk about what you're thinking about in terms of a trade idea you're willing to present to us today.
Sure. Thanks for having us. Really appreciate the opportunity to be here to present an idea to the group. As Susan mentioned, I was formerly a partner at Appaloosa with Dave Tepper. He's our fund's largest investor. At Incline Global, we run a concentrated portfolio with 25 long positions. And we have 3 different products. So we have a traditional long-short equity fund that runs 30 to 50% net. We have a long-only fund, but then we also have a market-neutral fund because I think we generate a lot of alpha and how people can play our alpha based upon what net exposure they would like. We also have a sector focus. We invest in primarily consumer-related and business service sector type names. And then finally, we also invest alongside proprietary business model patterns called frameworks. We've essentially created 8 proprietary business model patterns akin to Charlie Munger's mental models because we believe that our best investments have a lot of similarities where we've been successful historically. So what I'll start off in doing is just give you a sense of one of the investments we have and then maybe a couple other thoughts after that. So we had our quarterly conference call, our quarterly Zoom that I do every quarter. And I basically said that the theme of the call is a famous Rothschild saying, says the time to buy is when there's blood in the streets. and there's a lot of blood in the streets. And everyone has their own views of why there's blood in the streets and how that's going to get resolved. If anyone has any macro questions later, I can kind of give you the 5 different catalysts I think are going to play out over the next 6 months. But we think now is a great time to buy. We also run the fund off of an IRR-driven system we've been using since we started. The IRRs that we're showing now are basically, at least last week, as high as they have been at the bottoms of different crises. So whether it was 2020 during COVID or 2022, the IRRs are extremely high. And what I would argue is it was very difficult to build earnings models during COVID. It was very difficult to build earnings models during 2022 because there was a real recession. Now you're talking about kind of a self-inflicted, irrational tariff situation, and everyone has their own views, I'm sure, of the president and how this is all going to play out. But I think it's much easier to forecast earnings now than it used to be. And if you look at earnings, this morning we had a company, TransUnion, that had great earnings. Google's earnings were very good tonight. And I think that the earnings visibility is fairly straightforward, unless you're playing with a company that has a very direct line of sight, especially with China tariffs. But even given that, Walmart's at 35 times earnings, so I'm not really sure that matters. So our one initial trade idea that I would mention is I think a very attractive stock is called Fluor. FLR is the ticker. It's an engineering and procurement and construction business that basically is going to be a play on bringing infrastructure and manufacturing back to the United States and reshoring. They have big businesses in energy, so think about building energy pipelines, energy assets. Also just general kind of infrastructure throughout the country. They also have a big business in pharmaceuticals. They just got a new contract from Eli Lilly, as a lot of these pharmaceutical plants have to be brought back to this country. I think they're going to really benefit from that. They're also benefiting from data center construction. So we think there's a really large growth here. 80% of their contracts are essentially cost plus, and there's really no tariff impact. And just kind of from I kind of think some of the best ideas you can pencil out on a napkin, and so that way I would do that for you here, is the market cap of Fluor is $6 billion. They have $1.5 billion of net cash, which will be $2 billion by the end of this year. And they also own a $2 billion stake in a public company called SMR, which stands for kind of small modular reactors. So it's one of these smaller nuclear kind of businesses that I think are going to grow dramatically. And so if you do that math, you're kind of at basically $2 billion. And they just had an analyst day last month, which they basically are going to have roughly 600 to 650 billion of EBITDA this year. So that's about 3 times EBITDA. And that EBITDA for the next few years is supposed to grow at 10 to 15%. So I think it's really attractive. You could buy this stock around 3 times. What are the catalysts here? The catalysts are that they're going to buy back tremendous amounts of stock. They had authorized almost 20% of the current market cap of cash to buy back. And they also want to sell their stake in this SMR business and retain the ability to actually design all the plants going forward. So we think there's just tremendous value to unlock here with a lot of catalysts, and it's kind of in the sweet spot of what we're looking at. And we also like to have high IRR with ideas with beaten down entry points. And we think the stock at 35 is easily pencils out to 70 if you use roughly 10 or 11 times EBITDA. So that's one of the things we would think about. Obviously, one of the presenters here has mentioned that there's a Knicks game tonight. There's also an NFL draft tonight, by the way. I think the Carolina Panthers need a defensive lineman, so they're going to go pretty strong for a defensive lineman. And we'll see how that plays itself out. But one of the other ideas I think are really interesting to talk about, just briefly, is a lot of people in the family office space are falling all over themselves trying to invest in sports teams at crazy valuations. But you can actually buy a stake in the Knicks and the Rangers, extremely attractive. So the Knicks and the Rangers, most people think, are worth between $11 to $12 billion. And the current market cap of the company is $4.6 billion with $100 million of net debt. So you can buy this stock at a $4.7 billion value. And one of the things I lived in my life was the Steelers used to have a person named Art Rooney that owned the team. He was an Irish guy who was an amazing person in Pittsburgh, which is where I'm from originally. He had a large Irish family of 6 people. And when he passed away, everybody in 2008 got their stake, but they also wanted to liquidate it. So I introduced Dave Tepper to the Rooneys to buy a stake in the team. That was his first entry point. And we believe now, unfortunately, Chuck Dolan passed away a few months ago, and now they have a large Irish family with 6 people. It feels to me like Steelers 2.0. And we think there's going to have to be some sort of catalyst there to create values, because I don't think a lot of people want their brother managing all their money when they get a stake in the team. Nevertheless, Jim Dolan, who I think they're family members feel the same way about him as the fans do. So that would just be something that I would mention. And then, really lastly, what I would say is the other stock that's related is called MSGE, which owns Penn Station. So they own the Madison Square Garden building. But all the news with Penn Station is a big positive, because if you look at all the plans that to redevelop Penn Station, apparently to make it, if you want to waste some time, go online and say Penn Station renovation on your Google, you'll see these beautiful pictures of Penn Station that almost are like an alternate reality towards the hellhole that it actually is today. To accomplish that plan, you need to buy the MSG theater plus the sidewalk rights and the access road to create all that light-filled space. And that's about $500 million value. So if you look at MSGE kind of quickly, the stock's trading at 9 times EBITDA. They have a long-term lease with the Knicks and Rangers that grow at 3%. You can buy, for all of you who like to buy real estate, you can buy this business at 9 times EBITDA. The EBITDA is growing high single digits with all the growth of entertainment. And lastly, you may get some upside of Penn Station renovation being a very big positive. So, we think that stock, kind of is a double. So all 3 ideas we think that I mentioned, I think could easily double. And happy to provide any information. Again, thanks for your time.
Great, thank you, Jeff. That's a lot better than going into a private equity sports fund for the next 15 years. All right, well, we're going to wrap up with you, Gary, before we do kind of a round of very rapid-fire questions, okay? And let's hear about what you're thinking.
All right, great. Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals to help you get better returns in the stock market. Today, I want to talk to you about biometric security. But let's start with our regular disaster, little audience participation. I know you guys love that. So, right now, we're all using usernames and passwords. Raise your hand if that's working for you. Okay, good. No one. Oh, wait, one person. All right, so 2% of the crowd. Great, terrific. Okay. Raise your hand if you think you have more than 50 usernames and passwords. That better be everybody. Your Spotify account, your banking account, Venmo. Okay, that's pretty much everybody here. Okay. Now, you guys know best practices, right? You're supposed to have passwords like an eye exam, EFPTOZ, exclamation point, 004. Okay. Is anybody using those? All right. Bruce, good for you. Well done there. There's your security guy. Okay. Now, they also tell you, above all, do not use the same password on more than one site. Be honest. Be honest.
Nope.
Okay. Good for you. Good for Bruce. I do it. It's exhausting. Okay? So, let's talk about the disaster of all this, because I just had to migrate to a new computer. Just logging in to check the balance or pay my T-Mobile bill, that's 2 minutes. It's 2 minutes just to log in, and I had my password saved on that. If you don't, by the time you ask for your password and then go through, I just had to do that to get e-delivery for some of my mutual funds. 3 of them required me to call. That was 30 to 60 minutes of my time. Now, somebody tells you, okay, wait, we're going to go more secure. Let's go 2-factor authentication. Raise your hand if you think that's secure. This is a smart crowd. Good job. It's not secure. And the reason for that is 2-factor authentication does not confirm the person behind the device. It confirms that you have the device. Okay, so if any of you stole my cell phone and you try to log in and you don't have my password, you click password reset, and it says, okay, well, we sent a special code to your email. You have my phone, my email's on there, it's not hard to find. They say, okay, well, we sent you a text message. Guess what? You're holding my phone, you see where this is going. We're just confirming the device. It is completely, unbelievably ineffective. Now, let's talk about where this can be disruptive from a business point of view. Anybody know anyone who is on Twitter or X or social media trying to build a following, trying to get your ideas out there? Okay, right, a lot of people in this room. I do not have the largest social media account in the world, but even at my mediocre size, I get spoofed all the time. People will have Gary _ Brode. Instead of the O, they'll put a 0 in there. They've got my photo. They've got my logo. They have my firm name. They copy my content. On more than one occasion, I have been banned and shadow banned and unable to access my account. One time, I wasn't able to join a panel like this that I'd been invited to join. I couldn't join. I'd been locked out because of the actions of a fraudster. Now, if you think they're doing anything to help my business while they're in control, right? Lawrence Leopard, who does have a big FinX account, he's been banned twice in the last month, despite the fact that half the FinX community knows him personally and is all screaming, we'll vouch for him personally. Biometric security would fix all of this, right? We should not be remembering 50 passwords. We should not have to store 50 passwords. And for those of you who are saying, well, I've got a different password for everything, you're storing it somewhere, that's all secured with one password, right? You all have your username and password stored in your browser. I'm not going to ask this one. I guarantee you there are at least 5 people in this room where the password to your browser account is password 12345. We don't think about that. There are vulnerabilities all over the place. If you think this doesn't matter, I don't know what to tell you. This is the biggest issue in security. Now, when we watch the movies, right, how do these hacks happen, right? It's always like some cool-looking guy, or now it's always a woman, right? Very young, right? The steampunk glasses, and they're like, hacking the mainframe, right? Moving the RAM. I'm in! And it's fantastic, except guess what? That's not how it happens. Every one of these breaches, the MGM breach, it is when somebody pretends to be someone who has access. So if somebody were trying to hack deep knowledge investing, the answer is not to try to hack the back end. The answer is to try to pretend to be me. And you can think, well, just put a secure password. It can't be done. And the reason now is, has anybody seen AI spoofs? They are so good that people who have worked with their CEOs for decades are transferring millions of dollars because they were on the phone, they heard his voice, right? And we are this close to the point where the video, right, the video spoof is that good, right? Now you can start to, you look for the hands, you get someone to stick out their tongue, okay. So what do? What's the best option for biometric security? And the answer is, it actually has to be a hybrid of security and convenience. You don't get both, right? So like when you watch Mission Impossible and they do the retinal scan and the fingerprint and the voice thing and the gait analysis, okay, that's great if you're getting on a plane and they're cutting the 2 hours you spend in the security line down to 5 minutes. But what if you had to do that every time you wanted to access your email or your bank account? It's a non-starter, right? Speed matters. User interface matters. You need to be fast, you need to be accurate. So the company I want to talk to you about today is called AuthID. The ticker is AUID. It's a microcap, $100 million market cap. 0.7 of a second, they can identify you. They have software that identifies an insertion attack. Now, for those of you who don't know what that is, what that means is it is impossible to grab a photo of me or a photo of any of you, put it up in front of the camera. There's liveness detection. You can't use video of me and run that through, or an AI version, because it can tell if the photo is live. It can tell how you move against the background. It can tell if the source is correct. It actually has to be you. Now, it turns out that right now, the best combination of accuracy and convenience and speed is what's called a passive selfie. That's what you're used to if you use like your iPhone, you put it in front of your face. Okay, but iPhone is about 1 in a million. AuthID, 1 in a billion. If they were to try to ID every person on this planet, they'd get it wrong 8 times. We're going to call that good enough, right? That's in 700 milliseconds. They'll have it down to 450 by next year. All right? So, here's where it gets really good, because the company just had a huge announcement. Raise your hand if you're at all concerned about biometric security, right? That's right. Because If somebody has your password, we can change the password, right? If somebody has your face, what are you going to do, right? And that's why we're all nervous. We don't want our data out there. Okay, so authID just a couple months ago came out with something called privacy key. There's a public key and a private key. 0 biometric data is stored. What is not stored cannot be stolen. The best part of all of this is talk about future-proofing. Who's going to store less, right? Anyone old enough to remember that old TV show, Name That Tune? I can name that tune in 5 notes, in 4 notes, right? Someone says 1 note, where are you going to go? They're already at 0 data being stored, so nobody's ever going to beat them on that. The company in 2023 had revenue of $200,000. $200,000. Last year was 4 times that, $800,000. This year, assuming they sign no new contracts, right? We just sent the sales team home. They'll be between 4 and 5 million. That's on the business they've already signed, more than 4x. Companies like this tend to trade at about 20 times revenue. Well, 4 to 5 times revenue, $100 million market cap. Hey, there we are. But now start to think, what if they start to sign a few multi-million-dollar contracts? What's that do to your valuation for next year? Could be up 4x, right? We are not playing this to be up 40 or 50%. We're playing this to be up 10x in the next 3 to 5 years. That really is what we're looking for here. There have been some recent events. So the company just did a secondary offering at $4.50. And the company's typical banker is Madison Global. This time they brought in Damiari. If any of you are familiar, that is the investment bank that is partly owned by Eric and Donald Trump Jr. Eric and Don Jr. also invested in the company. That's kind of interesting because think about the implications for government contracts, right? Now, we don't have to get into the whole thing about how anyone feels about Doge and Elon Musk. Let's just skip all of that. And
That's the warning, you got 1 minute.
all right. Okay. But couldn't we have people actually verifying who they are to vote, to get their Social Security payments, to get government benefits? Because right now there are people, we can debate how many there are, but right now there are people who are double dipping and people who are getting benefits who aren't, who shouldn't be. This can all be cleaned up with authID. They signed a contract in November with an Indian company for $10 million over 3 years. I'm going to remind you, this is a company that did $800,000 of revenue last year. They just brought in 2 people related to this offering who are both on a new advisory board. They both run private equity and venture capital funds and have said in public, hey, guess what? Our portfolio companies are going to become authID clients. Every CEO in the country is terrified that their back end is going to be hacked, that their customer data is going to be out there. If you want to know what kind of horror they're worried about, just look at the MGM situation a year or 2 ago. That's what they're really worried about. So this is certainly the big area. And then the last point, I promise, new CEO, Ron DeGuro, has taken the company in a different direction. The company had horrible management before. And Ron, in the last year, has brought in half a dozen people from his former employer, SoCure. SoCure is a large company in this space. So I'm going to ask you, do you think people are leaving the large company at SoCure to go join Ron at this tiny $100 million startup because they think they're not going to sign this business, right? These are, watch the insiders move, the insiders in the industry. So I think this is a place where you can make a ton of money. It's certainly going to be the growth area in security for the next decade. Did I make it under the wire?
You did. So we're going to do like 3 quick questions about whether you care or you don't care about these things. If you don't care for your portfolio, this is about your portfolio, you can move on to someone who does care. You can explain briefly why you care. Does anyone on this panel care about geopolitics? All right. Everyone on the panel cares about geopolitics. So who would like to take that one first? Jeff, or Susan?
All right, I'll just stop, or I'll be quick since all of us do. So we don't use it to shape our portfolio from a top-down view. We don't say, oh, the risk of a recession is rising, so let's bring down our debt exposure. But we certainly use it, and for every company it's different, but there's macroeconomic factors that do matter to every single one of them. And we're actively following that and incorporating it into our view on that individual company's outlook, to be brief.
Anyone else want to throw their hat in on that question?
Yeah, I mean, effectively, that's, I would say, one of the core things that I'm looking at is a geopolitical macroeconomic investment firm. So thinking about the impact of various things, whether it's in Lebanon or elsewhere in the world, is kind of at the center of everything that we're doing. I think just one interesting stat that I was reading from a study, just quickly, I won't go too far off track here, was in the 70s, the average holding time of individual equity was about 10 years. That's come down to about 12 months, and the paper proved, I don't have the information in front of me, but they claim to show that given a shorter holding time, even for individual equities in the U.S., something like 70% of returns can be attributed more to macroeconomic factors than company-specific factors. You look at companies that have increased earnings prizes but still trade down, and vice versa. So I'm not looking at individual equities, I'm looking at the broader macroeconomic environment. But as you can see, I guess all four of us are very intrigued by how that affects the portfolio.
Great. And now interest rates.
Oh, hang on.
Oh, okay.
Yeah. So over the last few years, we've looked at COVID, shutdowns, tariffs, all of these things, and they all matter. They've all affected the macro environment. Just the fact that the U.S. Federal Reserve hiked rates faster than other central banks, we've made money off of the Japanese yen carry trade, right? The unwind of it. Like, these are all things that we follow. It doesn't affect which stocks we're buying, but it does affect the exposures that we have.
And interest rates. Do you want the Fed to lower rates, or do you think he's not? Do you care about this for your portfolio? We'll start with Jeff this time.
Well, my view is that you currently have, this last CPI reading was 2.4%. In that number, you have shelter, and shelter is running much higher than what the real-time tracker is. If you adjust for that, inflation is pretty close to 2%, oil's at $60, and there's a lot of other factors. This economy is slowing. I think the Fed raised rates too high, too fast. I think that they're way behind. The ECB's lowered rates 7 times in the last year. The ECB is now at 2.25, and I think the Fed having rates at 4.5 is way too restrictive, and the housing market's essentially halted. And I think it matters dramatically because if you look at the broader PE multiple for the market, I think that it's very inversely correlated to interest rates. And I think one of the catalysts is as the Fed lowers rates this year, the market's implying 3 to 4 times. I think that is going to allow the market to broaden out and increase the PE multiples of stocks. And the first question, I don't spend a lot of time on, quote, geopolitics, but you'd be living under a rock not to be spending time on the tariff impact for your stocks and the multiple and on earnings. So I think that's I also think the recent tariff situation is probably the biggest act of self-mutilation that the U.S. economy has ever incurred. With that said, it can also be switched by just you wake up one day and it can change. And as I was talking with the partner from Cedar Cooperman, is that we've been in a market narrative. I think of the world of market narratives the last 2 to 4 weeks, and we've been in a market narrative of new tariffs, new tariffs, new tariffs. Now I think we're in a market narrative of what's the next deal, and I think on the margin things are going to get better. And whenever the reciprocal tariffs came out with a chart that was obviously totally manufactured and ridiculous, that basically took the worst case scenario off the table. And now companies can start to plan and can start to give guidance. And as they give guidance, which they're doing now, it highlights the really undervaluation of a lot of individual stocks. And I think the valuations will expand as people get less nervous with the tariff situation, but most importantly, as interest rates get cut.
Great. Anyone else want to address rates or tariffs?
Yeah, I actually want to take the other side, part of what you were talking about. I actually think the Fed was slow and light in hiking. One of the things that we were tracking the whole time is the real rate, which for the last few years has been at or below 2%. So I don't know that the Fed funds rate has been nearly as restrictive as Jerome Powell has claimed it's been this whole time, but that's looking backwards. Looking forwards, I don't think it matters what the Fed does right now. I think they're completely trapped and irrelevant. And the reason for that is fiscal dominance, right? The Fed balance sheet right now is a little under $7 trillion. We have on-balance sheet debt in the U.S., $37, $38 trillion. It's probably changing while we're talking. And so it doesn't really matter. The Fed can cut, but everybody has this idea that the Fed controls the whole yield curve. They don't. The Federal Reserve controls the overnight rate. The bond market sets the rates for everything else. And so, as a reminder, the Fed started cutting in September. They gave you 100 basis points of cuts over a couple of months. And what happened? The yield on the 10-year went up by 100 basis points. That was not the way they wanted that yield curve to uninvert. And so, go ahead. They can try to lower rates right now, but that doesn't mean the bond market is going to go along with it. And I think what we saw in September, October, November was the bond market pricing in higher future inflation off of lower current overnight rates. I think we'd see that movie again. So I think there's really nothing the Fed can do that'll make a difference.
Okay, that's good. That's good. Good debate there, guys.
I just emphasize the inflation point of view. I think for us, we think that the economic data right now is actually more or less, it's still almost the minute it comes out because things are changing so rapidly. And we've seen a lot of companies who are raising prices between 10 and 20%. And that's going to take a few months to flow through, first, to the market and then to inventory. So it's not something that's going to show up immediately. But I think, and Pell referenced this last week when he spoke, I think it puts the Fed in really a tough position to cut rates with that headwind.
Go ahead.
Sure, yeah, I think off of your point, if you look at what's happening with the steepness of the curve, it's been becoming increasingly steep, and actually we're still significantly below, when you look at 210s or 230s, historical norms, and if you look at some of the more crisis periods, you could see a lot of that. So the way I would think about investing is not necessarily about the overall direction of the curve, but thinking that it's more asymmetrical upside to bet on something like the steepness of the curve continuing to increase, especially if you bake into account some sort of sell U.S. or lack of confidence in U.S.-denominated assets, which seems to have been the case with some of the moves in the 30-year over the last week and a half or so.
Great, thank you. And one last question. Which do you think will impact your portfolio and your positions more, the behavior of the consumer or the CapEx and infrastructure spend of corporations?
Well, I think, at least for how we invest, clearly what happens with the consumer, I think that's going to drive so much of the earnings of companies. I think right now, there was obviously a tremendous panic. We talked earlier, the VIX went to 53. There was massive panic. But during that, I think a lot of people were questioning, what are the actual earnings? Because the stock price is a very simple function of the PE multiple times the earnings per share. And during times of crises, you have to figure out what the earnings are and what's the probability tree around those earnings. I think that clearly if consumer spending is weak, that's going to cause earnings to decline, will cause advertising spend to decline. If you listen to Google's earnings tonight, they actually feel that the organic revenue growth was 14% in Q1. They had a pretty optimistic outlook going forward. And obviously, if consumer spending slows down, advertising revenues will slow down, and the whole market will. So for me, I think that's the most very important factor, which we're monitoring closely. We use a lot of alternative data. There's a lot of really good alternative data you can use. We use a whole bunch of different sources to track that, and we're not really seeing any material weakness other than a couple percentage points in a lot of companies' revenues based upon alternative data, and that's what it looks like it's coming out. I think that's why you're seeing the stocks start to rally, because people are realizing the earnings aren't as bad as a worst case scenario that you're seeing, and you can actually do the valuation of the stocks. A lot of stocks we're seeing look really cheap on the earnings that are kind of hanging in there.
Good. Jennifer, you want to add to that?
Industrials are more relevant for our portfolio. I think that just reflects our portfolio rather than kind of a grand macro view.
Gary or Greg?
Yeah, for me, these are all equity people, so they're better suited to answer. But for me, it'd be more country specific. So obviously, the U.S. is a very consumer-driven economy, but other places around the world are heavily dependent on either government spending or larger industrial or infrastructure type projects. So that's what I think about.
Great. Well, now we're going to open it up to everyone out here. You guys want to raise your hand and ask any of the panelists a question? I'd be happy. EJ will run around. Councilman Mike. Thank you, everyone. I think that was a good discussion.
Hello, my name is Soraya, and I have a question for Gary. I would like to know what your opinion is on auth-ID versus the open standards, such as passkey, that is developed by the FIDO Alliance, so Google, Apple, Microsoft, etc.
Yeah, so actually, auth-ID is part of that alliance, but there's no question it is a fragmented industry. The reason I'm focused on auth-ID is because they're the fastest, they have the best user interface, and there aren't a whole lot of pure plays that are publicly traded in that. But there's also no one more accurate and nobody more fast, and those are the things that are going to matter.
Thank you.
I'm going to ask a question on auth-ID. Why hasn't a private equity fund just bought it?
You know what? That's a phenomenal question. And when I first looked at this company a year ago, I described it, when I wrote up a lengthy report on it, I described it as a public venture capital company and said there's no way this should be a public company. And in fairness, like let's talk about one of the downsides of it, which is the management team. They're great at the technology, they're great at sales, they're inexperienced at running a public company, and so their communications have really been poor. They haven't done a great job of communicating with the street, and so many times, like I read the press release, it's not great. I call the company, I talk to them like, oh, everything's terrific. But the rest of the world doesn't have the CEO's cell phone number. And so there are issues with that. And it's tough when you have a small, young company like that. The truth is, it would have been better off being a private company, but the good news is we all have the chance to participate. But it's a great question, and it's certainly something that, was one of my first thoughts when I looked at it as well.
Hi, thank you. I don't want Gary to dominate this with the auth-ID, but this is an auth-ID question, and I have a comment for Jim. Does auth-ID have anything to do with ID.me, which the government makes you sign up for when you want to access things like Social Security or your IRS account, stuff like that?
So that is a phenomenal question. ID.me is different, and I can actually tell you I have recent experience with this, where I tried to go apply for a trademark and had to go through the ID.me process, and let's just say that took as long as it did to call Vanguard or whatever mutual fund I had money. It took me an hour to get through the system, and it bulked multiple times. So look, that's just my experience, but I don't think ID.me is fast. I don't think it's accurate, but it is what the government is using for part of their business right now.
So how would that be an impediment for auth-ID getting involved with government and things like voting?
It's not. It's a great comparison. I'm thrilled by it.
Okay, thanks. Jeff, real quick, just comment. I think the MSG and MSGE ideas are very interesting. It'd be great to own part of the Nixon Rangers. But you have Jim Dolan, so he's your partner in that. But anyway, it's a good idea, and I'll look into that one. Thank you.
Yeah, I think everyone has their own views of Jim Dolan. Our view is that we bought the stock with what I call a Dolan discount. So we're kind of getting, I think we're getting paid to accept his management. I actually think the Knicks are actually doing well. They're getting a lot of playoff revenues, obviously. I think that now that the father, unfortunately, passed away, the brothers and sisters are going to need some monetization at some point. There was rules passed in the NBA last year that private equity funds can buy 20% of a team, and also sovereign wealth funds and pension funds can buy 30% of a team. So don't be surprised in the next year or so if you see them selling a stake in the Knicks at $8.5 billion and allowing big share buybacks from the difference of that. In addition, the Rangers are probably worth $3.5 billion to $4 billion. They could sell stakes, in buyback shares. So we believe that there's big transactions that will be coming by selling stakes in the team at the private market value and buying back stock at the public market value. And finally, in the MSGE, they've been actively buying shares back, and we think there's really good value there. And again, without talking about politics, I think that I'd be remiss to say that President Trump had a rally in Madison Square Garden. President Trump is now taking over, whether you like it or not, the redevelopment of Penn Station, and I would be very surprised if his friend Jim Dolan doesn't end up on the right side of that situation, and we think MSG is a great investment given that.
Good point. Yeah, one right here.
Yeah, so Jennifer, if you could swear, you said that Broad Horizons is sort of resistant to recessions, and logically it makes sense that if you're laying people off, you're not paying for their daycare. So if you could kind of walk me through that. And then also, Gregory, if you could tell me how much exposure Lebanon's getting, or how much sponsorship they're getting from the neighbors in that region. I'd appreciate some clarification on that point also.
Yeah, absolutely. So in the prior downturns that they've gone public, so in the financial crisis is probably the most illustrative example. That was the deepest economic crisis that Bright Horizons has been through. Organic growth slowed to 2 to 3%. So you definitely do get as people are fired. But as parents have the choice, a lot of these centers are not, the employer is not fully covering the cost. It's often subsidized, or it's just co-located. So the employer opens a center and maybe gives them favorable rent terms, like at corporate headquarters. But they're not necessarily paying for the entire cost. You're absolutely right. If you're firing people, you're firing 20% of your workforce, that daycare may lose 20% of their census, right? In those cases below a certain threshold, they're allowed to take in community members to offset that, which is kind of a natural hedge. And over time, it's worked out such that people do maintain their children. I think there's a lot of disruption. I don't know if you have kids, but to moving them around. And so, and people are actively looking for jobs. So if you feel like you may be able to attain a job in the next 2 to 3 months, you may not necessarily pull your kid out of daycare to save that money. And kind of rock the ship. There's often long waiting lists too at these centers, and so you can't instantly sign them back up. And it's hard actually to be in and out the door. And so that's just what's happened to them historically.
Yeah. So about Lebanon's neighbors, look, historically Lebanon was kind of the play place for the Saudis, for the Emiratis. They would go. It's still an Arab-speaking country. Spend a lot of money and have a kind of less conservative form of life. Actually, recently, they've been putting a lot of economic pressure on the country. They've banned their citizens from traveling there, partially to put pressure on the country to appoint the people that they wanted appointed. The recent central bank governor was appointed earlier this April, was someone that was highly supported by Saudi. So at the moment, they haven't come out with anything specifically around what kind of development they're going to be putting in. But the expectation is some of that $11 billion of redevelopment will need to come from the Gulf countries. And that's part of the catalyst for the fact that they're recognizing that this is a bulwark against Iran, and rebuilding it not only provides them with kind of personal social value, but also security value in the region.